It's been 2 months since Trump became president, and I think it's fair to say it's been chaos, somewhat of a whirlwind. But I mean, what else did we expect, right? But this video is not about being political. With investing, you have to remain objective and you have to take each policy on its merits. But one thing for sure is that there's increased volatility, and it's that unpredictable nature that's not liked by the markets in the short run. So I'm going to split this into two parts. The first is that if you have a time horizon that is longer than 5 years, so you're investing for the future, you might not have a specific goal, but you just want the best return for your money. And then we'll cover if you have a time horizon within that 5 years. So if you're saving up for a specific purchase and you want to take a little bit of risk off the table, what are the potential options that you have? I should say that this is just my personal opinion and this shouldn't be taken as financial advice. So let's get into it. So let's start with the easier one, and that's if you've got a longer term time horizon. So the first thing I would say is try not to get too caught up with market news, sentiment, and the kind of press and the rhetoric that comes out, because it will overwhelm you and you shouldn't be too concerned with it in the short term. You can also look back in history as well. If you were to take any 5-year period, if we go back to the 1930s, that's when the S&P 500 first started, you can take any 5-year period, you would always end up with a positive return. Now, we can't always use that as a guarantee. That's just previous results. But that's a long time where any of those time periods, if you hold long enough, then you're going to have a positive return. Of course, within that, you're going to have, whether it's 1 year, 2 years, up to 3 years, where you could potentially be down. But as long as you hold it long enough, you're going to be good. In terms of increased volatility, that can actually be a good thing, because if you're investing regularly, it allows you that potential to get a better price, essentially. So if you're investing monthly, you may even have the option where you can invest daily or weekly. And you're not really too concerned about increased volatility because you're not looking to sell anytime soon. Then becomes the question of, do you pick the US market and go with the S&P 500? Or do you go with a bit more of a broader approach and go with a global index? I did put out a video yesterday where I talked through some of my favorite index funds, and that gives you a few ideas of potential ways that you can diversify. But specifically on that point, now with Trump's presidency, he generally wants a strong economy. He wants the markets to do well. And a lot of his policies are aimed at doing that. He's all for deregulation. He's all for lowering corporate taxes. The counter to that is what he's done more recently, and that's with the tariffs. You can ask virtually any economist and they'll tell you tariffs are bad. There's no winners with tariffs, because what essentially it's doing is increasing prices. And in an inflationary environment, what that then means is that the central bank can't lower interest rates. So we've seen interest rates slowly come down following the pandemic when they were increased to counter high inflation. But what we've seen more recently, and this is not just to the US, this is across Europe and other parts of the world as well, is that they've had to slow down some of those reductions in that interest rate because inflation is not falling as quickly as it was. Tariffs are inflationary because they're essentially increasing the cost that the consumer is likely to pay. Now, the manufacturer and the seller could potentially absorb that cost, but it's very likely that they're going to pass it on to the consumer, because if they're a manufacturer, say in the US, and they're importing a good that then they're going to sell, well, they're going to have to pay an extra tax on that if it's come from another country that has a tariff that's been put on it. And they have then the choice of either they pass it on to the consumer or they absorb the cost. If they then absorb the cost, then that increases the cost, obviously, as a business, which potentially then can have a knock-on effect on pay rises, wages of the actual workers for that company. So there's some real negative effects of tariffs, and this is what's causing a lot of uncertainty. Now, in the long run, things could be a lot more positive, right? The idea is that if you're a manufacturer and you're exporting to the US, and now potentially your exports are going to be affected because that US importer may not want to import as much as your goods. The idea is that then you go and, pack up shop and you move to the US, you set up your plant there, and then obviously then you're not affected by any tariffs. In the long run, if that works, that could be a positive thing. But there's just absolute no guarantee that that's going to happen. And that's where the uncertainty comes in. Now, I want to show you a graph that compares US equities and international equities. And this goes back to the 1970s. And what this is looking at is comparing when the US outperforms the global stock market and vice versa. And what really stands out in the last decade or just over is how much the US has outperformed the global stock market. What this shows is periods where the US has outperformed. So, for example, in the 90s, the tech bubble, the US massively outperformed the global stock market. Coming into 2006 to 2010, That was when the global credit crisis hit. There was a period where the US underperformed international equities. And then more recently, and this has been very tech heavy, so we've got 13.8 years now where the US has been outperforming international equities. What this tells us is that it's very cyclical. So we'll go through periods where the US will outperform, and then vice versa. There'll be times where international equities will outperform. And the concern recently is because of this extended period above the average of when the US is outperforming international equities. The question is there an expectation that that is going to come back towards the average? Now, there's nothing to say that that can't continue for another 5 or 10 years. So you could go into international equities thinking that they're now going to outperform, and the US could carry on outperforming for another 5 years plus. Then obviously you'd be better just staying in US. It's just an extra piece of information you can use to make your decision. And I just wanted to highlight it. Now let's look at the potential options you have if you have a shorter term time horizon. So if you're looking to sell within the next 5 years, you're saving up for something and you want to take some risk off the table. Now you can still go into some of those equities that we've talked about. You may just want to reduce the percentage in your portfolio that you're holding. The video that I put out yesterday also goes through a number of different index funds that will allow you some diversification as well. It's just a case of allocating a smaller percentage towards that. But what about the rest of your portfolio? So there's a few different areas that we can go into. And this is not about saying one is going to be better than the other. This is all about having a balanced approach. And the idea here is that you can spread that money around. So the first place I'd probably look at, especially if you're worried about de-risking, is have a small percentage in gold. So gold is very much seen as a safe haven during times of economic uncertainty. And if you have a fear that there's going to be a recession or a period of low economic growth, then gold can be a good place to park your money. Another area you can look at is having a small percentage in property. Now, this doesn't mean that you go out and invest in physical property. You can do this via a real estate investment trust. You can buy into a fund with a very small amount of money and still get exposure to the housing market. You can get capital appreciation in exactly the same way in terms of the fund increasing in price, but you can also get income paid out from that fund if you wish as well. The idea with looking at some of these investments is looking at things that might be a little bit more recession proof. Now, there's nothing to say that house prices can't dramatically fall. We saw that in 2008, although that was specifically linked to the housing market. But you're looking at products and services that people still need. So you're looking at consumer essentials, so things like food and energy, but also household items like cleaning and washing, things that you're going to use on a regular basis that people still need to have, regardless of what the economy is doing. Then you can have a look at bonds, and there's a number of different bonds that you can look at. Now, this just gives you another option if you don't just want to put all of your money in cash. So if you were to put your cash in the bank now, you're looking around 3 or 4%. That's what the current rates are now. They could potentially change in the future. With bonds, if you were to look at government bonds to start with, so this is obviously backed by the government, and this is essentially the government borrowing. So you're giving the government money, and then they're going to pay you an interest rate for borrowing that money. For a government bond, currently, you can look around 4 or 5%, depending on the term of that bond. So arguably slightly higher than what you'd get in the savings account, and it's still very low risk because it's backed by the government. You can get slightly higher percentage rates on bonds, but you're going into the corporate bond market. So this essentially, you're giving money to a company now who are borrowing, and they might pay you a higher interest rate, somewhat up towards 10%. But of course, you then take on more risk because you're going into the corporate bond market because you're giving money to a company. A lot of this depends on how hands-on you want to be. A lot of the stuff that we've talked about, you can go down a massive rabbit hole. If you look at different bonds, if you're having to monitor them every couple of months and you're looking to change, and say with the equities, I'm going to go with this for the next 6 months and then I'm going to change it, and you're constantly checking prices. And that's what you enjoy and you've got the time to do it, then so be it. But I think for a lot of people, and actually I think a lot of people would be better off doing this, is having a more hands-off approach where you almost set and forget it, and then you're less likely to make changes, is when we're constantly checking it, and it's constantly when we're looking to make little tweaks and changes. That's when we can make mistakes, where you have a more simplified approach. So you break down how much money are you looking to sell in the next 5 years if you've got a shorter term time horizon. Okay, how much money then do we need to de-risk and take off the table? You can still have a balanced approach. So you could still be saving for the future, could be retirement or something big later down the line. So you could still have that percentage in the stock market in an index fund, and then have the majority of your money in short-term investments. So like we talked about, whether it's gold, real estate, some bonds, and then obviously the majority in cash, you can still have that balanced approach. And I think that's the main thing, but really set out what your goals are and what your time horizons are. That's the first step. If there's something I haven't mentioned that you're thinking about considering, then let me know in the comments. Thanks for watching, guys. I'll see you tomorrow.